All right. Good morning, everybody. Welcome. Thank you so much for joining us for today's session on endowments investing to meet the climate crisis. My name is George Dyer. I'm the Executive Director of the Intentional Endowments Network. I am joining today from Essex, Massachusetts, north of Boston, which is the ancestral land of the Pawtucket people. And as we're talking about climate today, whenever we're talking about climate, we're really talking about people, communities, the impacts of climate on those communities, and the dynamics of inequality, racism, oppression are integral parts of that conversation. So throughout this conversation, we'll be looking to underscore the need for action on climate justice and to ensure that we navigate this transition to a low carbon economy in a way that is just and equitable, and that marginalized and oppressed people are centered and part of that process, informing and leading it and benefiting from this transition. Today's session is part of Climate Week NYC. There's a whole host of events happening in New York and virtually this week, and we're pleased to be a part of it and bring some really compelling stories around what endowments are doing to help with this transition. The theme of Climate Week is getting it done, and we've got some great speakers today who are getting it done and helping to really lead and drive this industry around climate risk and climate solutions. So you can see here our speakers. We have Madeline Clark from Cambridge Associates, Ben McEwen from Saracen Asset Management, and Jeff Mindlin from Arizona State University. So we'll hear from each of them in just a minute, and then we'll have a little bit of dialogue amongst the panel, and then plenty of time for Q&A. So please, as you listen to the remarks, think of questions and put them in the chat at any time. Next slide, please. So for those of you who don't know about the Intentional Endowments Network, we are a nonprofit peer learning network supporting endowments and their service providers in investing or in line of mission and sustainability. And we do this through events, working groups, peer interactions of all kinds, and disseminating and sharing resources. So if you're not a member already, please join and let us know if you have any questions about the network. Next slide. Just wanted to put a quick plug in for our Climate Action Pursuit, which is a series of events that have virtual events replacing our usual in-person summit this year. And we have 2 milestones left, October 7th and 8th and December 9th and 10th. So if you're already registered and joining those, please join for the final milestones. And if not, check out that website and join us for the second half of that programming. Next slide. So as we look at how endowments are addressing the climate crisis, we've been doing a lot of work in the network around the concept of net zero portfolios, and have an initiative around net zero endowments, supporting endowments and endowment decision makers, and understanding what a net zero portfolio commitment entails, pointing to the best resources and groups that are working on different elements of that to help support that, and just helping to make it as easy as possible for endowments to make those commitments and to drive that conversation within the industry. We recently put out a briefing paper, really geared towards trustees and investment committees and looking at those commitments. And you can find that on our website. So I encourage you to check that out and learn more. And again, we'll be talking more about those themes throughout the webinar. Next slide. So just a few logistics. The webinar is being recorded and will be available to members and registrants after today. And as usual, please enter any questions you have for the panelists through the chat or Q&A menus at the bottom of your screen there. And you can put in any questions or other input in the chat as well. So with that, we'll dive right in. I'm very pleased to hand it over to Ben McEwen, who's going to help us set the context around some of these issues of climate risk and get us in through the presentation. So Ben, over to you.
Yeah, thank you very much, George. Pleasure to be here with you today. Hopefully you've got the slides there for us, Gladys. If you'd be so kind as to bring them up when you get the chance. Perfect, thank you very much. So as the title of the seminar today is Investing to Meet the Climate Crisis, George very kindly asked Saracen to present our views about how we might facilitate this investment that we need to solve the impending climate crisis. So next slide, please, Gladys. So, I mean, the first thing to note is, as I'm sure you're all aware, that climate change is real. So this is a chart from the IPCC Assessment Report 6, which came out earlier this year. And what it shows is that we are seeing unprecedented warming. This shows from 1750 to 1850, and then today, and you'll see that preponderance of red. And indeed, each of the last 4 decades has been successively warmer than any decade that preceded it since 1850. And that now means that global surface temperature was 1.09 degrees centigrade higher in 2011 to 20 than 1850 to 1900. And as you may know, the goals of the Paris Climate Agreement call for us to limit temperature increases globally to well below 2 and aim for 1.5 degrees centigrade. The unfortunate reality is we've already breached that over land. We've already seen 1.59 degrees centigrade of warming over land, with an increase in ocean warming of 0.88 degrees centigrade. We then show that from today until 2100, there are various possible futures that we'll go on. So these range from very low to very high climate change. But you'll see even a best case of 1.5 to 2 degrees still sees significant warming locked in. Next slide, please. So further climate outcomes really do depend on emissions actions. So what we show here is 2100 warming projections and emissions reduction scenarios necessary to limit global average warming to 1.5 and 2 degrees. You'll see that the baseline takes us to something like 4 degrees of centigrade warming, with current policy projections at 2.7 to 3.1, pledges and targets at about 2.4, and scenarios with 2 and 1.5 outcomes needing very quick abatement of emissions curves. So we have to start bending these emissions curves, and we have to start bending them soon. Next slide, please. This means that the investment requirements are unparalleled. Gladys, maybe you could just click forward. There might be some other data that appears. So what this shows is that we need to at least triple investment into climate-related finance, whether that's mitigation or adaptation. So this is data from the global landscape of climate finance, which shows that investment into mitigation and adaptation solutions has been in the order of $600 billion a year. It has grown at a compound annual growth rate of 8%. We need to grow that to in excess of $2.5 trillion per annum. If we assume that that's achieved by 2025, then that's a compound annual growth rate of 28% from now and until then. So we're really talking about significant step changes in the quantum of investment capital that needs to flow to solve the climate crisis. Next slide, please, Gladys. So despite these sort of abundant evidence, we know climate change is real, we know the quantum of capital that needs to be deployed. Why is it that the market might still be mispricing climate risks and opportunities? And this is very important for us as an asset manager on behalf of our client to think about, how can we deploy capital into climate change solutions, mitigation and adaptation, and why there might still be an opportunity for our various clients. And what we show is that there's a variety of reasons as to why it might be the case. So climate change data availability and disclosure has been absent. There's been a sort of broad lack of literacy around climate change in capital markets. It's complex. This all contributes to sort of a lack of historical precedent on which to extrapolate, which capital markets find challenging. There's also this question of sort of time is inconsistent preferences and hyperbolic discounting. So discounting future scenarios that happen, 5 to 10 years out relative to what happens next year. And then, also very problematic is this beat the gun mentality. Capital markets might know that there are climate risks, but they think that they'll be the smartest person in the room and see the term before the market. So this to us indicates that, the rationale as to why climate change might still be mispriced and why there are opportunities. Next slide, please. So what we show here is, the industry has gravitated towards using carbon footprinting as a methodology to understand the climate risks of endowments or portfolios. We believe that's a very flawed approach. So what we show here is the carbon footprint of an example index and portfolio with a number of utility and oil and gas firms. And what it shows is the absolute emissions of those companies and then the intensity of those emissions. Now, we find this problematic from a number of perspectives. It ignores scope 3 emissions. For an oil and gas firm, that could be 90% of the footprint of a firm. It ignores sector-specific decarbonization pathways. So we know that the cement industry is harder to decarbonize than the electric utility. It ignores jurisdictional differences. So to George's earlier point about justice and equality, it really doesn't take into account the differential between emerging market economies and developed market economies. Critically, though, it ignores the direction of travel, and we're very fervent believers that capital allocation is the key to mitigating risk for firms. It also ignores the need to allocate capital to climate solutions. So again, where does this chart tell us which companies are deploying their cash flows to solving the climate crisis? It ignores physical risks. And at the end, it ignores engagement. Who fixes this emissions problem? If you have a low intensity portfolio, that's not necessarily reflective of low risk, and it's also washing your hands. It ignores engagement, and somebody else has to fix the problem. Next slide, please. So rather, what do we think about? So just very briefly, we think about investing and pressing. So we think about investing our clients' capital in mitigation and adaptation solutions. For net zero outcomes. We think about climate impact analysis. So how do we best model and convey the risks of climate change to our clients' capital? And then that's predicated on the Saracen Climate Pledge, in which we commit to press investee companies to align with the Paris climate goals. And we are very proud to be co-founding partners to Net Zero Asset Managers Initiative. Next slide, please. So what we try and do, rather than just use a sort of footprinting tool, is we rather try and reflect transmission channels that stem from climate change into security pricing for our clients. Climate stress testing, we believe, helps identify risks and opportunities in the transition to net zero. So what we do is we take a range of inputs, some of which are quantitative, so emissions and physical risk scores, but then we scenario model these for net zero outcomes and for physical risk outcomes. So what we're really trying to do is say, what happens to the revenue line of a given firm in a net zero outcome? What happens to the cost profile of a firm in a net zero outcome? So how might carbon pricing come into effect? We then drive two outputs. One is a risk analysis score, and the second is a climate value at risk, which I'll touch on the next slide. But critically, two outcomes as well: investment conviction, and then a significant informing of our voting and engagement work, which Saracen is, we like to think, well known and regarded for. Next slide, please. So what we show here is climate value at risk, which is really the methodology that I referred to on the previous slide. And what we're trying to do here is create two scenarios. One is a base case scenario, which integrates some climate change factors or net zero factors. And another is a climate or net zero scenario. So we're taking a base case discounted cash flow and then comparing it to a net zero cash flow, and the differential between the base case and the net zero scenario, we can attribute either to climate value at risk, which is shown at company A, where we believe there's a mispricing, the company isn't making that transition fast enough, or company C, where again, we believe that the company is being mispriced and investors are not taking significant enough advantage of the climate value opportunity from this company deploying significant quantum of its cash flows into net zero pathways. Next slide, please. Now, where are we in pricing these climate transmission channels is the obvious question. And what we show here is two charts. The first on the left is we show total shareholder returns of equities that we have done this analysis for in 2019, 2020, and 2021. And we take the climate value at risk score on the horizontal axis, and then the performance on the vertical axis. And what it shows is that in 2019, zero correlation. The market effectively wasn't pricing climate risk or opportunity. 2020 saw a significant inversion in that, and there was a marked increase in the correlation between climate risk, climate opportunity, and performance. Though in 2021, there has been some sort of downplaying of that again, as we've seen some sectors outperform that have noted climate risks with them. And then on the right, we just show that high risk climate value at risk companies, so those with significant climate risks, also have a significant beta to them. So that could imply a higher risk to a given endowment or portfolio. I think one last slide from me, please, Gladys. So hopefully I've conveyed, albeit briefly, how climate analysis really does shape our investment decisions, and stress testing for net zero outcomes really does inform our decision making. Where we see positive exposure, we generate increased conviction and potential position sizing. Neutral exposure, where we'll monitor, and then negative exposure. Companies with heightened vulnerability to climate-related issues will engage where vulnerable, and we believe they have the opportunity to build resilience, or if they're not building that resilience, we will divest of those because we believe that our clients' capital is at risk subsequent to the engagement. So with that, I think I'll pass it over to Madeline.
Thank you, Ben, for that overview. And thank you to George and IEN for having me on this panel. You are great partners in this important work. So my name is Madeline Clark, and I'm on the Sustainable and Impact Investing team at Cambridge Associates. And we work with a range of clients, including endowments and foundations, family offices, pensions, to design and implement portfolios that align with sustainability and mission objectives along with risk and return. And this topic of net zero is so important to our work as we look to the future and think about the realities of climate change and all the ways that Ben just laid out. And this is a big week for us in terms of our public commitment to net zero. Just yesterday, Cambridge announced a net zero commitment in our work with our clients. And this came out of work that we've been doing over the last several months with the Investment Consultant Sustainability Working Group that we've been a part of. And we had the opportunity to work with our peers to create the Net Zero Investment Consultants Initiative, which formally launched yesterday. 12 of our peers signed on to this, representing over $10 trillion in assets. And the commitment aligns our investment work with clients with the goals laid out in the Paris Agreement to reduce carbon emissions by 2050. And I think one of the really important parts of this commitment is also the interim target to reduce emissions by half by 2030, and making sure that we're really working towards this in client portfolios. The commitment further extends to our work in our operations as a firm as well, which is in line with commitments that we've already made as a firm. So we're glad that that's a part of the commitment as well. We're already working with clients on building net zero portfolios and look forward to expanding this work across our broader client base as we look to do everything across the spectrum of sustainable investing, from decarbonization of portfolios to investing in climate solutions. So as we approach climate issues and specifically net zero investing with our clients, we really want to focus on real world solutions and impact. I think Ben raised some great points around measurement, and we embrace the fact that measurement is going to come with its challenges, and we try not to hold ourselves in our investment decisions too captive to that measurement. We know that too much focus on that can at times lead to poor allocation decisions, either from a investment standpoint or a climate perspective, as Ben was talking about. And what I mean by that is we recognize that some sectors are going to be high emitters, but really need capital to transition to a low carbon economy. One example, Ben used cement as an example. Another could be a factory that is making metal components is going to have the same reported carbon if those components are used for a coal mine as if they were used for a wind turbine. And so we have to really consider the full use of the product over its life, and not just that snapshot carbon emissions. And so we look to partner with really thoughtful managers as we do this, that are considering all of the risks and opportunities associated with climate change, and also place really high value on engaging with managers, pushing them to be more thoughtful about risks and opportunities, and expanding that beyond managers that are just talking about sustainability to the full range of traditional investment funds that don't come out at the onset saying that they're focused on ESG and sustainability, and pushing them to be better on those practices. All of that said, we know that the whole economy really needs to change. And so as we evaluate our investment portfolios, we want to make sure that investments are aligned with a net zero future. And so our goal is to invest with winners in that transition and avoid the losers. And that might mean divesting or avoiding certain assets, such as fossil fuel reserves that don't necessarily have a place in that low carbon future. So we work to reduce overall portfolio emissions, but then one of the big focuses of our work with clients is on climate solutions and investing in positive ways to have an impact. So that can be in renewable infrastructure. We see a lot of opportunities in sustainable real assets. There's great innovations and technology advancements in energy storage and waste reduction, carbon capture technologies. And so climate solutions, particularly in private equity and venture capital, is a really exciting place for us. So we're finding great opportunities for our clients. And then, so we're really looking, that's sort of the range of how we work with our clients. And then one other element, just before I turn it over to Jeff, that I want to touch on that's really important as we do this work is we know that it's critical as we approach this process that we keep diversity, equity, and inclusion at the center of the transition. And we can talk more about this later, but I think in taking an inclusive approach is the only way that we can ensure that this transition to a low carbon economy is a just transition and doesn't further exacerbate existing inequalities. So I'm looking forward to the discussion and diving in more on these topics. I'll turn it over to Jeff.
Great, awesome, thank you. Pleasure to be here today. My name is Jeff Minlin. I'm the Chief Investment Officer at Arizona State University. I oversee the foundation's endowment. For those of you not familiar with our institution, we're a large public research university located in Tempe, Arizona, which is a suburb of Phoenix. We just welcomed about 134,000 students back for the fall, including 77,000 in person and 57,000 online. Those numbers include 10,000 international students and also 10,000 veterans. And 45% of our on-campus first-year students identify as an underrepresented minority, and 1 in 3 are actually first-generation students. So university is very globally minded and socially embedded with our community. We were ranked #1 in innovation for 7 years in a row, 5th globally for achievement of the UN's SDGs. The university reached zero greenhouse gas emissions on the operations side last year, which is a couple of years ahead of plan. Platinum rated by STARS, and last week we're rated #1 by CR Magazine's Cool Schools ranking. So this is kind of who we are when we're talking about sustainability and net zero. You know, I feel like we're governed by our charter, which is imprinted on a 2-ton piece of granite outside my window and imprinted on the back of my business card. But the idea of our charter is that we're measured not by whom we exclude, but who we include, and how they succeed, and that we're taking responsibility for the economic, social, and health of our community. So again, these are all themes that are core to how we operate. So like most public universities, the philanthropic arm is a separate 501c3 known as an institutionally related foundation. So we're a separate entity, which means that alignment needs to be more intentional. And so when I joined a little bit over 4 years ago to start building out our first investment office, a big part of my mandate was how do we best align our investment strategy with the mission of the university. Our endowment is about 1.3 billion, maybe a little smaller after yesterday. But we do work with BlackRock on the OCIO side, and they've been a key partner in this process for us. We really view sustainability and our evolution there as a journey, not a destination. A big part of how we've been thinking about this is, how do you define responsible investing for ASU? I think every institution is going to be unique in how they look at it. Early on, I was really focused on little things like, okay, is tobacco something that we can be thinking of because you're not allowed to smoke on campus, and it was very micro. Whereas we started talking to stakeholders, students, faculty, staff, really the themes of what responsible investing means at ASU was a lot bigger. And ultimately we arrived on this idea that ASU is a transformational catalyst. And that was very helpful in thinking about how do we want to align our investment strategy with that mission in mind. So last year, on the heels of the university achieving carbon neutrality, our investment committee made a net zero commitment to be net zero by 2035, which aligns for the next phase of the university's carbon neutrality ambitions. And again, the idea is that as a transformational catalyst at the most innovative university, we can be a leader that others can learn from, and we want to make sure that we do it maybe before others, so there's a path that others can follow for the more widely used 2050 goal. But that causes us to be a leader and take some risks to get there. Ultimately, and you heard a little bit about this earlier from Ben, but we know we're driving towards a cliff on climate change, and we don't want to wait until we're at the edge till we slam on the brakes. So we wanted to be earlier to start trying to make our intentions known. For us, getting this done and getting a net zero commitment really was about tying it to fiduciary responsibilities. In our statement, we talk about that climate risk is investment risk. We talk about the ongoing energy transition presenting an investment opportunity. It was really important for our investment committee to not lose sight of the fact that their objective is to serve our beneficiaries as fiduciaries. So I think for us, really, the net zero commitment has been very clarifying for us. For a while, we knew that we cared about ESG, but how you define the E was maybe very vague. So having this idea of net zero as how we're going to do it and how we're going to measure things has been really important over the last couple of months. Again, it was really important for us to declare our intention, and then now we're shifting into how do we measure the impact. And this isn't easy, right? I think all too often my peers and colleagues will avoid making some of these big steps because it's not clear how to get there. I mean, we're not going to be there overnight. And how you define it, how do you do it with a multi-asset class portfolio? How do you measure it? What are interim steps? None of this is easy, but again, I think for us, it was really important to declare our intention early on. Another thing, and this is, I think, interesting for those trying to get things done, is that, net zero was, I think, an easier pill to swallow for our committee than any kind of divestment statement. If you, again, go back to our charter, we think more about, who we include, not who we exclude. So we think of that on the investment side as well. The importance is not, what's not in our portfolio, but what is in our portfolio. Our committee also, I think, has been averse to divestment. So, again, I think a net zero approach, which is more holistic, was easier for them to conceptualize. From an academic perspective, limiting your investment universe tends to result in suboptimal outcomes on the efficient frontier. So, that's been a hurdle where net zero isn't doing that. And I think really importantly, and you've heard a couple of items here, and we'll probably dig into it deeper, a divestment way of thinking about it, you lose your voice as a shareholder. And we've been really focused on proxy voting and engagement. And this is, I think, a really critical, important part of the transition. And then I think lastly, as a big research institution, the nice thing about net zero, right, is you get credit for the negative side. And that research with our Global Futures Lab, the nation's medical school for the earth, as we dub it, is doing a lot of work in that regard, especially on carbon capture. So again, I think that negative offset side is important versus the prior divestment side. And this is a natural evolution. when we look at our portfolio 4 years ago, we had about 6.1% exposure to fossil fuels. As a fiscal year end, that was under 3%. And again, that was done because we've made no direct private fossil fuel investments, and we've pulled no thermal coal companies, but that's been more organic and natural by better integration of BlackRock and our managers on these ESG factors into the portfolio, rather than an explicit mandate. So up here you see kind of our timeline of what we've done along the way. I think the most important thing that we're working on right now is next month releasing our first SRI report, where again we start to try to measure the impact of some of these intentions and strategies that we've made, and really start to define what our strategy is. Part of I think reporting is it causes some of the awareness of some of these challenges that we're going to face. Looking at metrics, even in a public markets portfolio, there's some of these metrics that we like that only have coverage of 40 or 50% of the names that we have, and that's not even counting as you get into multi-asset class with fixed income or private markets, and other things like that. So again, I think it's a journey to get there, but we've taken a step, and we'll continue to be public about where we're going and what those challenges are. So that maybe I'll turn it back to George.
Fantastic. Thank you so much, Jeff and Madeline and Ben. Again, just great leadership on all of your parts, and so exciting to have these, in many ways, kind of first movers or early movers. Madeline, congrats on the announcement of the commitment. That's so exciting. And I'm going to try and sort of scatter a few calls to action for the audience throughout here as well. But if you are a Cambridge client, I would encourage you to get in touch and learn more about what that means and how they can help you. And if you're not, see if your consultant has made that commitment or is looking at it, and ask them why not if they haven't. Because I think as we have some precedent for this now, it's a great opportunity to get things moving. And likewise, Ben, as a founding member of the Net Zero Asset Managers Initiative, I think that's another thing that can give a lot of endowments, kind of comfort to know that the manager community is moving on this and answering some of these tough questions. And while there are a lot of open questions, I mean, answers are coming. There's a lot of great minds and resources being focused on this now. And Jeff, I just love that transformational catalyst framing. And I think all of this is really what it's about. And so, I think the importance of making these commitments, as you said, Jeff, is really critical. So again, to our audience and listeners, if you're at an endowment or an endowment stakeholder, really encourage you to push to make these commitments, because that kind of collective action definitely sends a signal to the market, and it's the kind of thing that's is needed to help us get there. And particularly in the run up to the COP26 meetings this fall. And I think the whole globe is looking at that, and it's a real opportunity and a necessary time to kind of make some of these bold commitments. So thank you all again. And as you said, a lot of open questions, so there's a lot of directions we could go here. We've got one question in the chat so far, which we'll get to in a second, but just please put in others. And I have a printout of the many questions that you all asked as you registered, so there's no shortage of questions. But if these comments sparked any new ones, please drop them in the chat. But to get us going, I wanted to kind of circle back to where we started, and again, kind of keep this issue of climate justice front and center. And Madeline, start with you about how Cambridge is thinking about sort of the intersectional nature of net zero and climate with racial equity and DEI. I'll mention too, before I turn it over, that our net zero endowments group has been talking a lot about this. We did a Q&A piece with some of the members exploring this concept that we can circulate to participants after the webinar. And we're working on a more in-depth paper that will go deeper in this. And I know Cambridge has been doing a lot of work on this too. So Madeline, would love to just hear a bit more from you on how you all are thinking about that and helping clients think about that intersection.
Yeah, definitely. I mean, as we've stated sort of throughout our time together already, we know that climate change disproportionately affects already marginalized populations. And this transition really has the potential to exacerbate existing inequalities if we don't take a thoughtful, inclusive approach. And we see this theme across the portfolio. If as we talk about the transition to the low carbon economy, we have for years talked about this idea of stranded assets, but we also in the process don't want to see stranded workers or stranded communities who are not brought along in the transition. For example, you see workers in high carbon emitting industries like coal miners, oil and gas, meat producers that are heavily comprised of low to middle income rural communities. And we really need to be intentional in the way that we look at workforce development and reskilling workers for this transition. There's opportunities to invest in infrastructure in different ways that can be really thoughtful in what communities are impacted by where you're placing facilities, and what communities are being impacted by just all of the negative externalities of those infrastructure investments. I think as our role as allocators, one of the best ways that we can ensure that we're considering this is to make sure that you're just putting it up front in your policies, and as you're writing investment policy, that you put climate justice at the center and make sure that you're having that inclusive process. For us, we spend a lot of time looking at bias across our process. We know that investing in diverse teams improves outcomes, and also we need voices from a lot of diverse perspectives to make sure that this transition is a just one. And so we think about that in the way that we select managers, and also in the ways that managers are set up in their own teams and their own investment process and their awareness of these issues and the bias. So asset allocators have a lot of opportunity to really engage with managers in their portfolio, and also reflect the mirror on themselves to see where are we not looking at these issues or overlooking certain opportunities. So I think it's both an engagement, but also looking at yourself to say, are we thoughtful in the way that we're considering this?
Absolutely. Jeff or Ben, anything to add?
Yeah, I would say, I think, similar to what Madeline said, the impacts of climate change aren't going to be distributed equally. Locally here in Phoenix, we see that older, lower income and minority populations are disproportionately impacted by increases in temperature. And so it really becomes key to think about how do we avoid the harmful unintended consequences while maximizing social benefits of this transition that we've been talking about. I think you really can't separate the two, similar to how we think about ESG and all of those pieces integrated together. You can't separate climate from social justice. And globally, it's hitting developing countries first. It's not easy though. Similar to what Madeline said, I think we're focused on the micro level of what can we impact in the short term, which is trying to bring more diversity to the portfolio. And sometimes it's just asking the question. One of the things I think that's interesting is we had a CEO from a local utility come and speak to students a while ago. And he was talking about, balancing the climate benefits of phasing out one of their coal-powered plants with the, job and economic benefit that plant has in a Native American community. And so again, I think these things are hard, but I'm glad that we're asking the questions from the get-go. I think we've tried to pivot a little bit to trying to talk about, how do we do it, not should we do it, and I think that's a really important change in this conversation.
Yeah, I mean, the only other thing, sort of supplemental factor I'd add is, I think there's a necessary focus on the just transition, but we also need to remember the just adaptation, right? We're talking about climate change because it impacts societies, and it impacts especially emerging market societies disproportionately. So we have to think about how can we incentivize and allocate capital globally to help those communities in emerging markets adapt to the already physical manifestations of climate change that are going to get significantly worse.
It's a great point. All great points. And, we've heard a lot as we've, kind of socialized these ideas in the network that it can be a lot, and it is a lot, a lot of complex issues, and trying to take them on in an intersectional way seems like it makes them more complex. But I think, as Jeff said, they are inextricably linked. And so, I think by moving them together, we have a better chance of avoiding some of those unintended consequences or missing things that would undermine our goals. And I would just underscore too what Matt was saying around stranded communities, and just the idea that while fiduciaries are in this paradigm of needing to think about fiduciary duty in all of these decisions, to recognize that from a global perspective, the migration, climate impacts driving migration and disrupting communities and driving political instability all are systemic risks to investment portfolios. So there's really just looking at it from that investment perspective, the need to do this and to keep it front and center. All right, so I'm going to turn to back to Jeff on this one and talk a little bit more about the shareholder engagement piece. We're sort of framing this around getting it done, the theme of Climate Week, where the rubber hits the road, so to speak. And so I'd love to hear how ASU is starting to think about proxy voting and engagement, and how that influences the investment process. And then we'd love to hear from Ben and Madeline on that after as well.
Yeah, I think it's another interesting, evolution. I think for a long time, asset owners, viewed proxy voting as a chore, and it was, something that had to figure out how to get it done. But I think it's really, switched to an opportunity, as I mentioned before. In a world where we're not focused on divestment yet, this becomes a powerful voice for us on how we start to affect change and affect that transition. One of the things that we've done is engage students with this part of the effort. Our president's known to say that higher ed makes up less than 2% of the carbon footprint, but we make up 100% of the learning imprint. So this experiential learning and bringing students into the mix is really key to us. We actually had a group of students help us craft our proxy voting policy, which again, even though like a lot of allocators, we don't have a lot of direct stock ownership, has been a great tool for us in having the conversation with our underlying managers on how we'd like to see them voting proxies on our behalf. We're increasingly talking about increasing the amount of SMAs in the portfolio and taking back some of those perspectives. We've had a conversation recently with As You Sow, with a tool that they're rolling out that makes that easier for asset owners to do. But I think that's key. But again, I think at our size and scale, we oftentimes rely a lot on our partners. So having those conversations with BlackRock, having those conversations with other of our underlying managers on what they're doing on our behalf is really important. But leveraging our students has been a really key way of extending the reach of our small team on getting these things done, and again providing, I think, a valuable educational experience too.
Yeah, I mean, the only thing I'd add really to Jeff's comments is Saracen has long, or certainly for the last few years, taken quite a robust stance in its proxy voting. So we have voted against chairpersons of boards if we feel that the capital allocation strategy or the strategy of the firm is not aligned with a Paris type target. We've also voted against audit committee chairs if we feel like the annual report and financial statements themselves, critically, we spend a lot of time engaging around financial statement construction. And if the financial statements of firms that we invest in on our clients' behalf do not adequately reflect climate risks, then we'll vote against the audit committee chair. We'll vote against remuneration chairs if we feel like the remuneration policy is non-Paris aligned. So it's not sufficient for us to have a firm that has a 10% weighting to reducing emissions if 90% of the remuneration of the firm is predicated on increasing fossil fuel exposure of the firm. So there's an inherent sort of dichotomy in some remuneration reports. So we'll vote against remuneration chairs. We'll vote against auditors. So we have certainly been accused, well, perhaps not accused, but sort of noted as being quite aggressive. But in our view, proxy voting is a very important tool whereby we can convey our clients' perspectives that firms aren't taking adequate action either to adapt or mitigate. So yeah, I think it's just going to rise up the agenda. It is sort of the prelude to divestment. And I think, as Jeff noted, it's a super important and growing sort of band of travelers together.
Yeah, I think those are all great points. I'll just add on that Jeff raised the point about resources and ability to engage. And I know there's a scale of different size of institutions and ability to engage with managers, and just an encouragement that you can engage at every level. And Ben pointed out the ways that they're really thoughtful about proxy voting, and that might not be within your bandwidth as an institution or an investor, but you can always be pushing your managers to do more. I think we try to really use our scale as an institution across our client assets to push managers, particularly where we have a lot of investment, to be more transparent with how they're voting, to make sure, particularly in instances where you have a larger manager with multiple strategies, that they have default positions that are to encourage disclosures and to align with climate objectives, and not, as Ben was saying, just going along with maybe the company line. So there are ways to do this at every level, and it can be in the proxy voting arena if you have the bandwidth to do that, but also just asking questions of your managers and really pushing them to be more thoughtful on how they approach the issue is a great place to start as well.
Yeah, that's great. And that's a question we get a lot. It was actually, I'm glad you addressed that, Madeline. It was the top question here about how to have those conversations with managers. And I think, I mean, as you just said, I think it's about having those conversations, right? It's working with your consultants and just pushing that, expressing that desire that these issues are important. And I would imagine, I mean, you work a lot with clients on explicitly working that into the investment policy statement too, so that that message is stronger.
Yeah, definitely. And Jeff raised the point of just sharing your policy with your managers. You might not be the one who's voting the proxies because the manager is, but if you have a policy on how you want to see that voted and you're passing that along, that sends a powerful message as well.
Great. And that brings us to our next question, actually, around how to build that buy-in amongst board and government bodies to get these issues into the investment policy statement. But before we jump there, I missed a couple of my call to action opportunities. So I want to encourage folks, as we were talking about the intersectionality and the issues around race and DEI, to consider signing the Belonging Pledge, which is a very straightforward pledge to bring up racial equity at your next investment committee meeting, if you haven't done that already. And I think sending that signal again helps just build that collective action. And a similar initiative, Due Diligence 2.0, that is a commitment to, adjusting the due diligence process so that it addresses implicit bias and other factors that put up barriers to more diversity amongst managers. So we'll add links to all of these in the chat and follow up with them after. And Gladys already put in the chat a link to the As You Vote tool that Jeff mentioned. As You Sow, the organization has a new platform called As You Vote that we partnered with them on to help endowments, and particularly small and medium-sized endowments, to have a proxy voting service essentially that is aligned with strong ESG principles that are also customizable. So if that's of interest, definitely be in touch with us too. We can set up a call to learn more about that. But coming back to this question around how do you build that buy-in at the governance level, I think that's so critical. And I guess, Jeff, maybe we'll come back to you, and then Madeline would love to hear about how you work with the clients on it. But Jeff, maybe just a quick bit about, you talked about the difference between divestment and net zero, and how net zero is more attractive to the investment committee. But can you talk a little more about just how that process went and how this was kind of codified?
And I think, it's been a long journey, right? And I think at any one time, sometimes maybe not feeling like it's moving as fast as maybe everybody would want, but then, you look back historically and all the progress we've made in a fairly short time. And, I think institutions and governance are in a place for a reason, right? And so I think everybody starts to be very thoughtful and intentional with it. Our process has been similar to a lot. You got to start off with some education. I think similar to students that I've taught, when this topic first comes up, most of our committee thinks of one of two things, right? Either we're talking about divestment or we're talking about impact, where you're giving up returns. And so, the educational process that there can be, net zero or responsible investing as a fiduciary where you're not doing either of those things became really important. And then I think, part of it is meeting everybody where they are. We had some committee members that really, I think, felt more strongly just about the rising tide. That regardless of whether they believed in it or not, that as more money flowed into green strategies, it would provide opportunities for better return and lower risk. And in some ways, that was kind of the avenue to grab them and kind of move them along. Whereas others were maybe more proactive and progressive in their thinking. So consensus building was really key. Again, getting the university alignment piece of it, and it was important, and getting buy-in from all the different stakeholders at the university, I think really helped move our committee along. And then lastly, I'd say again, our partner, BlackRock especially, I think being able to demonstrate that this journey was possible without giving up return was really key from that fiduciary perspective for our committee to make that leap in a net zero context versus a divestment one.
I think as we work with our clients, I think this conversation, Jeff, you raised some of these points now and earlier about how we move from, sometimes there's a reaction to the conversation around divestment, and taking this into a more holistic conversation about climate and what are the risks and opportunities in the portfolio. I think from just a pure fiduciary standpoint, if you're not considering climate risks and opportunities in your portfolio, you're going to be missing something and could lose big in the long run. And so as we work with clients, I think it is becoming more and more mainstream in those conversations with investment committees to just understand those risks, and it makes the conversation a little bit easier. And I would say it depends on the institution, how they respond. Those that are more mission oriented or a foundation that has goals around environmental issues is going to be more open to aligning their portfolio earlier than ones that don't have that express commitment as an institution. But it's still a very important part of just investing generally. And we look to partner with our clients to really understand where are the hangups and where are the places that people need to get over the hurdle, what myths can we overcome. So spending a lot of time educating the various stakeholders to understand where they're coming from and how we can help them understand why this is important for their portfolio management, but also for the world, and having that positive impact and making sure that we're on the right side of history in this issue.
Indeed, and I think we often hear how important peer references are too. And so again, I think the importance of some of these early movers can't really be overstated. And just to recognize that there are a lot of large investors in Europe that are members of the Net Zero Asset Owners Alliance and have been working on this and are really deeply committed. And then here, in the U.S., several endowments and some, big name endowments, in addition to ASU, have made this commitment, including Harvard, Michigan, and Stanford. And again, recognizing that there's a lot to be learned and sort of create the runway as they take off, sort of, so to speak. But there's some good company to be a part of in making these commitments. But I wanted to swing back to a specific question we had about the correlation of returns and the climate value at risk. And a question around, would you run that correlation over longer time frames, and would that be more powerful over longer periods?
Yeah, I mean, I could talk to you all afternoon about this. But in the interest of brevity, yeah, I think, certainly, as investors, what we're trying to do is deliver optimal returns for our clients from today onwards and manage those funds in alignment with how they want to be managed from a sort of ESG integration perspective. But it's very much our belief that if we look over the long term, to our analysis, there is very limited probability that the market is still accurately pricing the risk and opportunity of climate change. So I think if you were to run a sort of historic regression model, the results would be somewhat limiting. They wouldn't sort of give you any sort of demonstrable correlation, but it's where we go from now. And where we go from now is that we have 3/5 of the world signed up to net zero targets at a country level, albeit that those NDCs are not aligned with where we need to get to. We're also seeing the increased ravages of climate change appearing on our doorstep. So we are having to adapt. So it's very much our analysis showing to us that we still believe that this is a very powerful investment theme, both on the mitigation and adaptation side for our clients, and that over time that will deliver significant outperformance.
Absolutely. And I wanted to come to another participant question we had related around the time horizons. And I think one of the values and kind of benefits of the net zero framework is that it is long term. And so you can see this progress, you can work with companies and drive this impact in the real economy over time. But as we all know, we don't have much time, and we need to have impact now, we need to reduce emissions now. And to meet some of these 2030, 2050 goals, we'll take some concerted action now. So, we had a question just about that in terms of how short-term goals should be incorporated into a 2050 pledge. And so again, recognizing that it is early days for many folks that have made this pledge and are going about it, and just trying to think about target setting in some cases. I don't know, Madeline, Jeff, or Ben, just from your own experiences, client experiences, how you thought about 2025, 2030 type targets, and how that factors into the longer term commitment.
Yeah, I was just saying that's kind of the stage we're in right now, is starting to think about what do those short-term targets look like, and building them, and again, I think there's messaging benefit there. Again, all this, as we talked about, I think is a process, right? I mean, as more and more asset owners and managers start to declare net zero intentions, it becomes a message to all the companies out there that they need to think about it, or they're going to be excluded from the potential investment universe. So it's a process. I mean, I think we're going to have 2025 goals, 2030 goals, 2035 goals, and then the measurement. There's been questions about metrics and measurement. We've looked at carbon intensity, obviously scope 1, scope 2 emissions. Starting to try to broaden all of our access to data and I guess call for data so that we can be reporting these things more accurately going forward. But we're just starting to tackle that question right now.
Yeah, I would just add, we have clients that have made full net zero commitments by 2030, and then also later targets. And then we have other clients that are really wanting to be thoughtful about decarbonization in the portfolio now and investing in solutions, but are choosing not to make a public timeline commitment, but are wanting to be really thoughtful about the real world implications of their portfolio. And so I guess what I would say is, don't let the timeline specific element hold you back from doing work in your portfolio now and seeing those places where you can shift, and making sure that as we've talked about, that measurement of your footprint isn't prohibiting you from making good investment and climate decisions today.
Ben, I'll give you the last word on this.
Yeah, wow, what an honor. Yeah, I just echo Madeline's point, which is to say, when you're thinking about the decarbonization curves of portfolios or endowments, certainly our perspective is one has to be very careful about assuming sort of linear reductions, because linear reductions mean that you might not be investing in electric utilities that have Paris-aligned capital allocation strategies. You might not be investing in steel companies that are deploying significant capital to solving the climate crisis via developing green hydrogen based technologies to develop steel. So just using linear reductions to get you to a point by 2030 or 2050 might increase your investment risk, and it might not actually help the climate.
I think that's a great point to leave it on. It comes back to your points around the limitations around carbon footprinting and sort of being too myopically focused on that. And actually, the topic of our next session will be on carbon footprinting, and hopefully we'll go deeper into the kind of pros and cons and pitfalls around that. I'm glad I put the link to that in the chat as well. So we are at time. I want to thank everybody. I do want to put one last link in, or a couple last links in the chat here. One is, as we're talking about pledges, I think a great resource from Project Drawdown, talking about climate pledges and sort of some of the pitfalls to consider and how to think about how offsets play a role, timelines, and other factors. And that link and many others are on our page and our website, which I'll just drop in here as well. Ask Latitude around net zero endowments. So we'll again send all of this as follow up. I want to give a huge thanks to our panelists for a great conversation today, and again for all the leadership you and your organizations are providing in this space. We'll have much more to come on all of this, but thanks everybody for joining today. And please do be in touch. If you're considering making a commitment, please reach out. I want to help you do that as quickly as possible and effectively as possible. So thanks again to everybody. Have a great day. Be in touch.
Thanks, George. Thanks, everyone.
Thanks, George.